Hello and welcome to Livewire Markets Fund in Focus. My name is Anna Dadich. Today I'm speaking to Nick Markiewicz from Ellerston Capital. He's going to be talking to us about the opportunity in the global small and mid-cap space. Nick, welcome.
Thanks for having me.
Could you provide a brief introduction to your firm?
Sure, yeah. So I work at Ellerston Capital. Ellerston Capital's an Australian-based boutique investment manager. We've got investments across a whole bunch of areas, but predominantly equities, both global and domestic, as well as private assets. The firm's been going for nearly 25 years, which may not sound like too long a time for some people, but in our industry, that's actually a very long time. I think that puts Ellerston as one of the longest running boutique managers in Australia, so there's real heritage there. And then the other, I think, interesting thing about Ellerston is we have a family office heritage. And I think that's interesting because it really informs the DNA of the business. It informs the investing style. Families are all about long-term thinking. They're all about continuity. They're all about managing risk. And they're all about investing where the opportunities are rather than by a specific product set, like maybe a retail investor might. And so I think that's a really interesting DNA of the firm, and it informs how we invest, where we invest, and what we do.
So let's talk through the strategy. The fund was launched in 2017. What's different about the way you invest? Yeah,
look, I think the way it goes back to Ellerston's DNA, the comment I made before. There's a lot of inhibiting factors around what causes managers to maybe underperform or invest the way that they do. There's a lot of constraints on managers, whether it's the index, whether it's the narrow part of the market they look at, whether it's how many stocks they hold, things like that. Whereas what we do is effectively take that family office investing style. We're looking for long-term investments. We're looking to grow our investors' capital. And we're looking to remove all the artificial constraints that maybe impact other investors. So things like benchmarks, fund size. We cap our fund sizes so we can increase performance for our investors. We have an incredibly flat structure in the office. We've got a big, deep bench of investors and a very large team as well. So we're trying to remove all the things that maybe other managers struggle with, and then we're trying to take that investing style and we're trying to apply it to a part of the market where we think we can make the best money for our clients. And for us, that's the global small mid-cap space. We love small mid-caps at Ellerston. We like them for a few key reasons, but the main one is we think they're undercovered by the market, and so we think there's better opportunity to make money there because if there's fewer eyeballs on a company or a stock, by definition it means there's more information to be discovered. And so our efforts have better bang for buck in the small cap space. We also love small mid-caps because there's just incredible opportunity out there. We have a universe of thousands of stocks. We can touch more parts of the market than maybe other investors can. We can look at specific themes, markets, countries, industries, things that other investors maybe can't if they're sort of pigeonholed in a part of the market.
Mm-hmm. So specifically for an Australian investor, what's the best way to build meaningful exposure to global stocks?
Well, I mean, they've got lots of opportunities and choice. You can buy an ETF. ETFs are fantastic at giving you cheap global exposure. The number of ETFs, there's actually more ETFs than stocks now globally, which is a pretty amazing statistic. But ETFs are a great way to just get general exposure cheaply to the market, and it's a really good way to get exposure to large caps. Or you can choose an active manager to manage your money. And active management, there's a lot of great managers out there that are doing really amazing things. But within active management, you've got a choice of using active managers who cover the whole market or active managers that specialise in a certain part of the market. And we like to think we are, Ellerston as a firm, but also globally, we are specialists in that small mid-cap space.
So what is the opportunity you have identified?
There's probably two parts to that question, but the opportunity more broadly in global small mids I think is really interesting at the moment, and it's why when I joined Ellerston I really wanted to focus on small mids specifically. But we're at a fascinating point in the market where over the last 10 years large cap stocks have comfortably beaten small cap, mid-cap stocks in terms of performance. And the reason for that is simply the performance of the Magnificent Seven. So the 7 largest companies in the world have basically been all the alpha in the market. And that is, these are wonderful businesses. They've done incredibly well. But there's open questions around whether a $3 trillion business can become a $6 trillion business as opposed to a smaller company maybe growing in size. But you've had this anomaly where the largest companies have effectively driven all the performance. And that is actually quite different to historically what's driven market performance. If you go back 25, 30, 40 years, it's consistently been smaller companies that have outperformed larger companies. And that's just by definition of being small. Smaller companies have a bigger ability to grow. They're often in more interesting, higher growth areas, whereas larger companies are typically more mature. So I think the opportunity today is, in small mid-caps particularly, is the market is so stretched in terms of the size of these large cap stocks, their valuations and their future growth from here, whereas you have this neglected part of the market that just hasn't done as good a performance as the large cap side. And I think we're at a really interesting pivot potentially there because interest rates are potentially about to fall, and that's typically very, very positive for smaller companies. And then, as I said in the start, larger companies, the Mag 7, may struggle to keep doing the same numbers they've done from here. So that's sort of at a high level. I think small mid caps are at a really interesting point. And then within that, there's obviously individual parts of the market that we particularly like at the moment, and specific companies that we think are going to do quite well.
Why is this a compelling opportunity and how are you investing in it?
We tend to like two types of opportunities. One is what we call fallen angels, stocks, high quality businesses that have fallen a lot for various reasons. And we also like businesses that we think have a much better growth profile than maybe the market appreciates. And so one business I think falls beautifully into that second bucket there is a business called Corpay. It's a US payments company. They do the three parts of their business. They have a fuel card, which is what truck drivers use to pay for fuel. It's the number one card in the US. They've got a thriving Brazilian business, and they've got a cross-border FX business. And they are now actually the largest cross-border FX provider outside of banks globally. Why this is a fascinating business, number one, I think, just look at the history. This business has compounded EPS at 20% for 20 years. That puts them in an elite club. I think there's only 10 to 15 companies that have done that historically in the S&P 500 today. So we're talking a business in the top 2 to 3%. Having that as a background, the market only prices this business on 14 times EPS, which is a very, very modest multiple for that historic growth. What the market misses, I think, is the stability of the fuel card business. People see it as cyclical. It's not. It produces a lot of cash every year, and that cash is going to those exciting parts of the business I mentioned before. And those parts of the business used to be very small, maybe 20% of revenue. Now today, they're about to be 40% next year after they make a number of acquisitions. So the business mix is changing for the better. And then finally, this business has grown through acquisition over its history, and the market tends to not include that in their forecasts, even though they make acquisitions every year. So wonderful business, great EPS growth, valued at 13, 14 times earnings is a rarity in this market. The second business we think is really interesting is Warner Music. Everyone knows Warner Music. When we turn on our Spotify, we listen to Warner songs, Universal Music songs every day. Warner Music is a great business, or I think a really interesting business today, because it has a bank of content and IP that is non-replicable. They've made content over the last 50 years that is still being monetized today and is going to be monetized in the future. There's very few companies that have 50-year IP that will be monetized going forward with very little incremental cost and capex. Why it's interesting today is you've got a very modest starting valuation, and the company is at a pivot in its earnings growth. And the reason for that is their relationship with Spotify is about to change. All the labels are about to start putting more regular price increases through. And for a fixed cost business where the content has already been paid for, in some cases decades ago, that drops straight through to the bottom line and should mean that EPS will grow very nicely. So we like the business because it's a high quality business, great assets, but importantly, its earnings are going to grow with this new Spotify relationship, regardless of what happens in the economy. So also a really nice place to be.
Nick, are there any particular themes that you're looking at in the space?
So I think like every other investor in the world, we look at AI, and we are invested in AI. That's the biggest investment theme, I think, over the last decade. Unlike a lot of our large cap peers who really have limited choice in how they can invest, in the Mag 7 effectively, which, like I said, are already great businesses but priced to perfection. we can look at a whole bunch of companies that are exposed to, what we would call the picks and shovels plays of AI. And where we really like to focus our time and attention is when we find pinch points in industries where a lot of value is going to accrue to a small number of players. And at the moment in AI, it's power. Power is the number one constraining factor, and there's a lot of smaller companies that are levered to that theme. So we have investments in those. They're not as large as, say, an investment we have in Warner and Corpay because they have a different risk profile. But certainly a lot of those companies are very exciting and potentially have a big future ahead for them.
What are the key risks in this space and how do you manage them?
So the key risks, I think, in global really come down to interest rates, FX and geopolitics. And they're all, maybe not geopolitics, but interest rates and FX are semi-linked. But interest rates at the moment really define what pockets of the market people get excited by. If interest rates are high, shorter cycle businesses with low valuations, high cash flow tend to do well. And if interest rates are low, what's called duration type stocks, companies that have cash flow and growth that go decades into the future is what people get excited by because the value of that future cash flow is a lot higher when interest rates are lower. And so the challenge of building a portfolio today is the market is still undecided on where interest rates are going and what that means for equity valuations. There's talk of interest rate cuts in the market today, which is driving some interest in these sort of shorter cycle names. But at the same time, long-term rates actually haven't moved that much. So the bond market is basically saying that they still think inflation is a bit of a problem. And so the challenge of building a portfolio is, what bets do you make with interest rates, given if you're totally skewed to one style of investment, you can have pretty dramatic moves in a portfolio and your moves relative to the market as well. So I think the biggest risk that we're trying to manage at the moment is having a nice mix of different businesses that aren't necessarily driven by where rate expectations are going. And most importantly, having businesses that have their own catalyst path ahead. So whatever interest rates do, we have a business that we think is going to grow EPS through that, and the valuation is going to improve as earnings do. So that's our job, to try and remove as much macro rate sensitivity as possible and build a book of companies that are going to grow under their own steam. I think the other challenge at the moment, particularly in global, is geopolitics. We've seen, I think over the last year since taking over the portfolio, a number of events, whether it's tariffs, whether it's Middle East tensions, you name it, things that, or going back 2-3 years, the invasion of Ukraine. So, these are what used to be once in a generation events that have all sort of seem to be happening every 6 months at the moment. And so the challenge is having a portfolio that's resilient to events like that, but also not putting too many eggs in one basket. So I think diversification is the other way that we try and protect investors, having investments in a lot of markets, not being too exposed to any particular geography, theme, industry, and having a more balanced book, as it were.
So what role does your fund play in a portfolio?
So, I'd like to think that we can produce a nice set of returns that on their own right stand up well against other managers and ETFs. But I think going to my point before on diversification, I think a lot of, if I look at a lot of financial advisors that we talk to, everyone has a home bias in terms of how they invest. They're overexposed to Australian equities, they're overexposed to maybe private assets in Australia as well. And then, they do have a global allocation, but that global allocation tends to be either ETFs, S&P 500, or managers that have a large cap focus, which invariably is the Mag 7 and the S&P 500 because it's such a large part of the index. So I think where the conversations we have is about financial advisors trying to diversify their investor holdings, and particularly in the global side, trying to diversify maybe away from the S&P 500, given the performance it's had, given the concentration that has now to the Mag 7, and then also given the underperformance of small mid caps to date, and how those move relative to maybe rate cuts in the future. So I think it's a really nice setup for small mid caps at the moment, and I think small mid caps have a big role to play for advisors and investors who want to have a different return profile in their portfolio.
Thanks, Nick, for sitting down with Livewire today and sharing your insights about the global SMID space.
Thank you.
If you enjoyed that interview, make sure to give it a like and don't forget to subscribe to our YouTube channel. We release new content every week.